The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN Wednesday morning, just after 9 a.m. Eastern Time. We got some retail sales data. Strong numbers, jumping 3% in January. They're talking about it in the Tiger's Den this morning. Some great points talking about, hey, some of those numbers, you know what they're accounting for? Higher prices, not necessarily greater sales of individual goods. You're talking about higher prices, potentially pushing that number, but nonetheless, you're talking about big numbers on the retail sales front. That follows a CPI print a little bit hotter than the market expected yesterday, and right now we kick things off slightly in the red. You see the volatility right at 8:30. We'll zoom it in. First, you got 7 o'clock. We jumped to 41.42. There's your volatility on the 8:30 retail sales numbers. We'll jump over to that in a moment. We spiked to 41.16. We make it to 41.36, just like that. S&P's now negative about 22 points right now, trading at 41.24. NASDAQ 100, we're off by about 0.5%, 12,568. You're negative by 62 points. Dow, off about 0.4% right now, just under 34,000 right now in the Dow, 33,972. Crude, chopping around at about 78.38. We got the gold contract. There's some action for you. Gold, off $22 right now at 18.43. You see the volatility on the CPI. We've had some dramatic moves in yields, in currencies. We're going to take a look a little bit at the yields coming up in terms of the market projections for where the Fed will be. That's changed a lot in the last 15 days, man. Market really hasn't kept up with the change that we've seen in terms of the market expectation for higher yields going forward. Gold contract, though, negative by $22. We'll talk about yields, and then we'll talk about currencies at 40 past the hour as we talk to our man Teddy Kegstad, as we do every Wednesday at 40 past the hour. We jump to notes and bonds. There's your action yesterday, kind of continuing the trend, right? Lower price, higher yield coming in. The 10-year, just from yesterday, down about a full point. You see the volatility again today as continuing the trend right now. We're talking about a 10-year yield, 3.77%. The yield on the 10-year right now. You jump to the 2-year. You see the volatility from where we were yesterday to where we are right now. You have a 101 handle on the 2-year right now. You can jump to the 30-year, negative by about 2 ticks, 126.28. We jump to some currencies as we jump around this market with 21 minutes to go until the opening bell. There's some movement for you folks. Yesterday, I was joking about in my program coming up yesterday, right? Let's zoom in on just yesterday morning, all right? And I was talking about in my program. Yeah, did the program from 9 until 10, of course. There's the action. I was joking, hey, at 8:30 in the morning on the CPI, it was 102.50. But guess what? By 9:30, it was 103.50. And today, it's 104. Just that quick, man. You talk about a pullback below 103 yesterday, volatility in currency markets, and just like that, we're pushing dollar strength at 104 right now. We're pushing higher yields. You're pushing lower market. And that is on the heels of a pretty strong retail sales number. You jump over to the headline, man. 3% in January, quote unquote, and CNBC, they like to be as tantalizing as possible with their headlines, smashing expectations despite inflation increase. Market was looking for about 2%. This article has it at about 1.9%. The Dow Jones estimate comes in at 3%. Are not adjusted for inflation, meaning that consumers outpaced the inflation 0.5% inflation rate for the month. So you have the inflation rate in there, right, of 0.5%. If it goes up 0.5% for the month, it's basically flat, is one way to look at things. But nonetheless, a big number, but you're still seeing some of those prices matter. Now, I wanted to jump over. Rebound sharply in January, and that's the graphic that I wanted to get there. Retail and food services sales changed from the prior month. You got to go back all the way. Last year, you didn't see anything like this in terms of the acceleration we just got, man, to a big number with 3%. We'll see how the market digests that number in terms of how you get into it on the open. Food service and drinking places, motor vehicle and parts dealers, and furniture stores led the sales increases. Food services and drinking places, 7.2%. Motor vehicle and parts dealers, 5.9%. Furniture and home furnishing stores, 4.4%. 2.4% in gas prices. Service stations flat. Online retailers, 1.3% increase. Electronics and appliance stores, 3.5% increase. No category saw a decline. Pretty remarkable numbers, man. When you talk about a December had sales falling 1.1%, everybody, I guess, was done with the shopping for the holidays. They were waiting for January, and we get a 3% pop following the December decline. And yeah, that's why I was jumping around to the chart, because that's a strong rebound, man. Even with the market looking for almost 2%, it blows it away to 3% following 2 months of declines, beats expectations. Following yesterday's number and following the jobs number, it's difficult to comprehend how this market is holding up so well, because good news is not really good news right now with inflation numbers running where they are, right? Good economic news is great economic news if inflation is not a problem. Inflation is a persistent problem. We saw it yesterday. If we get stuck, and we'll talk to our man Kevin Hincks after the break coming up, interesting to see what he thinks of yesterday's action and how that comes into the retail sales of what we're seeing today, because he was pointing out, and I thought rightfully so, those were some hot numbers yesterday, man. And I don't think we're supposed to get sticky. And these are my words now. I don't think we're supposed to get sticky at around 5.5% core CPI. And that's kind of almost what you could be making the case is happening right now. You add in the jobs number, you add in retail sales going up 3%, you add 500,000 jobs a month, and you add in inflation getting sticky about 5.5%. I think that means the Fed has a long way to go. I believe Chairman Powell would understand that, and I don't think he's going to shy away from the battle, folks, at least right now with where we are. We're adding 500,000 jobs. We have the S&Ps above 4,100. It's quite a statement to what's going on. Now, this is the article I wanted to get to. Markets come to grips with the Fed on interest rate, okay? A journal article out early this morning, and the coolest part about this is it talks about how the markets have adjusted, where they think rates are going to be. For the longest time, the narrative was, right, the market didn't believe the Fed. They were convinced that although the Fed said they were going to stay higher for longer, they would roll over the economy. They'd get to the point that they'd tame inflation, and then they may even need to cut by the later part of this year, right? That narrative is now going away, okay? Check out this chart. This chart, okay, in the bright blue, you have February 14th, yesterday, okay? Now, pay attention to the dotted pink line, which is February 2nd. The expected federal funds rate at the end of this year, folks, as of February 2nd, was what? That's at about 4.25%. Probably that's pinning between 4.25 and 4.5, 4.375, something like that, right? This is less than 2 weeks ago, folks. The end of this year, the market had a Fed funds rate implied of under 4.5%. Well, where is it now? Yeah, you're above 5. So you're talking about a move of about 3/4 of a full point in terms of where we'll be at the end of this year in 12 days. That's a mammoth adjustment in the market in terms of the rates that they are expecting, okay? And you see the shift. And the shift entirely takes place basically in the latter part of this year. You see where we are now. You see where we are towards the end of 2024. And then at that point, at the beginning of 2024. And then at that point, it seems like the market and the Fed implies it's going to decline. Well, since February 2nd, folks, if we've seen that type of a difference, the market hasn't really reacted, man. February 2nd, yeah, that's our high at 4,200. We're sitting at 4,125 right now, and you're talking about mammoth moves. We'll talk to our man Kevin Hincks when we come back, folks. Stay tuned. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We have the S&P futures negative by about 21 points right now. That's just over 0.5% in the red. Let's jump over to our man, Kevin Hincks, every trading day, folks, right here on Tiger TV from the TD Ameritrade Network Fast Market with your host, Kevin Hincks, Tom White, the whole team at TD Ameritrade Network. They got some great guests on the program, folks. They had Randy Frederick on earlier this week. Randy used to do a program at TFNN, folks. Outstanding program, education every single day at 12 o'clock. And Kevin, we got another data point this morning, man, 3%. Pointing to quite the economy we have going on. Good morning, Kevin.
Good morning, Tommy O'Brien. Yeah, another day, another strong, much stronger than expected, top-tier economic data point, Tommy. And this time it's retail sales. Down 1.1% a month ago. They were thinking it might rebound up 1.7% as high as the expectations. It comes in 3% higher, Tommy. X vehicles, again, down 1.1%, looking for up 0.7, comes in 2.3% higher. So X vehicles and gas, down 0.7, consensus up 0.6, comes in up 2.6%. So big consensus beats here with retail sales, Tommy. And it's interesting. You know what? March 17th, Tommy, a month from now, will mark 1 year since the Fed started raising rates. They raised 25 basis points on March 17th. So 11 months we've been raising rates. And this month we got 500,000 jobs, prices going up 0.5% and 6.4% year over year, and retail sales up 3%. The question really that the Fed has to ask is it working? Is what they're doing working out there right now? And the question is no. Why is it not working? It's probably not working because the government is spending money as fast as the Fed can raise interest rates, Tommy. I think that's why you're seeing the numbers that you're seeing, in my opinion. But, boy, this is an economy trying to find its identity, and it's two heavyweight forces working against each other.
Man, I appreciate you coming on the program, Kevin, 3 times a week at a busy time right before the open. We get these data points because you provide so much great information like that wrap up right there. It's amazing that we are where we are, and I hadn't even put it in my head really. I think a lot of people, time flies, right? You know that we're through this journey, but pretty remarkable. We're coming up on the 1-year anniversary of them actually raising rates when, boy, the market was already well off on its way to realizing what was going to happen a year ago already in terms of pricing in some of that action. I was reading an article from the Journal earlier this morning, Kevin, talking about just kind of how the market has finally repriced to meet the Fed's expectation of the implied rates going forward. I found it pretty interesting. They compared basically where the market was looking for the Fed implied rate basically coming into February about 2 weeks ago versus where it is right now following some of the numbers you just got. A dramatic shift upward basically for the second part of this year, where for some reason the market had been pricing, as we're all aware, maybe some even cuts. That's kind of gone away to the wayside to 2024, where the Fed was kind of looking. What do you think of the fact that the market has been able to kind of readjust where they imply those Fed funds to be, kind of lining up with what the Fed's been saying all along? And we've had some volatility, we've had some pullbacks, but at the beginning of February, Kevin, we were pushing maybe 4,200. We had some big days at the beginning of the month in February. We're still above 4,100, and the market has now adjusted in pretty dramatic fashion. What do you think of that kind of correlation, that the market holding up so well right now, even in the face of adjusting to the fact that we might not get cuts later this year?
Yeah, listen, I think if you're Jerome Powell, you're a bit frustrated, but you're also feeling the fact that it's nice to have a strong economy that you can raise interest rates into without doing any significant damage. And so it's a double-edged sword, Tommy. You'd like inflation to come down at quicker rate. I mean, think about the Eurozone today. UK CPI, Tommy, it came in, their year-over-year numbers are 10.1% higher in inflation. That came out very early this morning from the UK. So inflation is everywhere, Tommy, and it doesn't seem like it's going away, mainly because spending is still out there. The U.S. consumer just showed you that they're still spending. Governments are still spending. So we're at an interesting time. I don't know how this is going to play out. I mean, there's no history book on something like this, Tommy. So you just got to stay nimble, keep watching the markets. I mean, I think they're going to get volatile. I think a 19 VIX feels a bit absurd with everything that's happening. That seems relatively inexpensive. So, yeah, I mean, these are interesting times we live in, Tommy.
You sum it up well, man. I'm trying not to hold in the chuckles, but when you surmise everything you're talking about, it's like, man, we are living in some interesting times, folks. Just yesterday, Kevin, I have a 5-minute chart up. I just zoomed in on basically yesterday's action on the S&P. I mean, we got 60 to 70 point moves in the S&P once, twice, 3 times, maybe 4 times yesterday alone with the VIX, as you said, under 20. Some mammoth moves. And today we're basically pushing pre-market session lows right now, down about 26 points with about 6 minutes to go. Where do we look forward to next? Before we get to the program today, Kevin, we just came off. You said it, right? We got the jobs number. We got the Fed. We got the CPI. We got retail sales. I know we have earnings, but what's kind of next on your radar as we come into kind of just past those big numbers?
Well, tomorrow will be PPI, so that's another look at the U.S. economy. We had mortgage apps come down significantly today, 30-year mortgage rates jumping from 6.18 to 6.39. That does a number. It's funny, Tommy, the easiest thing to connect the dots when rates go up is mortgages and housing in general. But industrial production we have coming up here, it probably just came out, actually, a few minutes ago. We've got more data coming out this morning, more. Tommy, this is a market we're getting to the second half of earnings season now, so. But certainly, you got to look at the entirety of this economic data and make a decision. And the question that lingers for me, Tommy, is this. Do we have another on the horizon? Because he's gotten away with 2 pretty dovish, a Fed conference, and then an interview after that where he's come across pretty dovish. The Fed speakers that are going to come out, they're going to hammer this market, talking about higher for longer and more restrictive. But across working here, Tommy.
Yeah, like we referenced yesterday, right? Is this where we were supposed to get a little sticky? And we're not stuck, but we're definitely not moving at the pace that probably some of those on the Fed and market participants may at least be hoping for. With that in mind, Kevin, what are you guys talking about at 12 o'clock coming up today on Fast Market?
we've got some good names to look at. We're going to definitely treat Shopify. We're going to definitely Roku. Or do it's coming up tomorrow morning before the open. So we've got to come. Shopify, definitely trading Roku, finalizing our third and final name, Tommy.
Folks, check it out every trading day, 12 o'clock. And Kevin, I appreciate your time, man, because we talked to you right before that market opened. I know sometimes you're on the air at TD Ameritrade Network before you talk to us. Then you're on the air afterwards, man. Markets always moving. We appreciate it. We'll be watching at 12 o'clock today, Kevin.
Thanks for having me on, Tommy. Have a great day.
Always a pleasure. Folks, tune in every trading day, 12 o'clock. You heard it. Shopify. Look at Shopify this morning, jumping up to about 52.19. You check out Roku shares. Roku shares up as well. Interesting, right? We get some positive action there with the market deteriorating as we speak. S&P's basically pushing pre-market session lows at 41.20. Come on back, folks. We've got the opening bell in 3 minutes. S&P's negative by about 0.6%. We'll be back for the opening bell.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. You have markets open right now with the S&Ps. Basically, as I said, pre-market session lows, right where we were at about 3 a.m., right where we were on that spike low at 8:30, 41.22, negative by 24 points. get ready for some action, folks. You saw it yesterday in terms of the two-way action. As Kevin said, VIX at 19, man. You're talking about moves. You take the upper threshold, don't even take the tails in terms of where we were at 8:30 on the CPI number yesterday, about 41.70. You made it down to 41.20 twice, folks. You made it down to 41.10 last night. Huge moves across the board in this market right now with the VIX sitting at 19. And yeah, I would remind you, before we get to Taiwan Semi and Buffett dumping his Taiwan Semi, I kicked off the program, folks, before I talked to Kevin. I talked about this, and this is what I was referencing, talking to Kevin about the expected federal funds rate. Just to reiterate, because I don't think the market has repriced really where it should if this is the type of difference it sees. You're talking about 3 additional, basically, hikes, right? Or lack of cuts, however you want to frame it. The bright blue is where we were as of yesterday. This is probably even exacerbated a bit. Right? This is probably even higher. Show me the February 15th one in terms of where we are, because I'm guessing it's a little bit higher on that retail sales print in terms of right now we got higher yields coming into today even. Okay? But it can't overstate, folks. Look at where we are in 2024, when 2024 begins, which is talking about the end of this year. February 2nd, you were at about 4.3%, and you just went up basically a full percentage point. Right? Yeah. I got to do it again. 3/4 of a point, we'll call it. The market has gone up in terms of where it thinks the funds will be, the Fed funds rate will be for the end of the year. Now, one case is that it was seeing some cuts in there, okay? But look where it thought it would be in terms of the peak. The peak, okay, of the federal funds implied has now gone like maybe June or July being at a peak of 4.75 to being all the way at about 5.2. Mammoth shift, and that's only since February 2nd. Okay, so you take a look at the daily, you say, okay, well, that's quite a shift in terms of where we are. And yes, we've had a pullback, but not really, folks. All we've done is consolidate. There's February 2nd. It correlates, not a coincidence, okay? Not a coincidence. Where did the market peak out at on this acceleration to begin the year? It was a one-way trip, folks. January 1st, 3,800. February 1st, 4,200, February 2nd. But you get the point, okay? 400 points up, more than a 10% rise. And yes, since then, we've consolidated a bit. Yes, you can make the case that we're down, what, 75 points? That's what, almost a 2% decline in the indices. But the way I would say it is that we're just consolidating near that top. And meanwhile, the market has adjusted to the tune of 50 to 75 basis points. So keep that in mind, man, as you go forward, even with this data, which is going to exacerbate things further. Now, the implied federal funds rate for how that change has occurred has been because of some of the data that we've gotten, okay? So it's not like the data is going to pile onto it. The reason why that change has occurred is because of a hot CPI number, a hot jobs number of 500,000. Now we have a retail sales number of 3%. And the market's saying, you know what? Inflation's sticky. The economy's still super hot. I don't see the Fed needing to cut at the end of this year at all, and maybe even peaking out at higher rates. The market's taking it in stride, man. It's still holding on to double-digit gains that it put up in 30 days coming into that number. So there we are. All right, now let's get to Taiwan Semi. Buffett, he unloads 86% of his position only months after declaring it. $3.7 billion sale. And yeah, Taiwan Semi is lower today. This isn't usually how he goes, right? Usually when he loads into a position, he holds it for an extended period of time. And yeah, I would say that investors are a little bit worried. It's surprising that Berkshire cut its holdings so much in just a quarter, which differs from its past practice of long-term investment and continuing to add shares. So much for not the case, man. And maybe it was just a case of, guess what? At any price, at some price you might be a buyer, at some price you might be a seller. Taiwan Semi down about 5.5% today on that news. But he came out with this position last quarter, right? The quarter that Taiwan Semi made down to $60. And what happened? You ran up to a price point by January 18th of $90. You're talking about a 50% gain in a couple months. You know, at some point, maybe he saw the value going to 90. He got it in a couple months. Not usually how he rolls, but you're not usually getting these types of moves in markets in the overall in terms of how they roll. All right, what else we got pulled up? Yeah, let's talk about Airbnb, man. Strong numbers from Airbnb. I got a couple articles pulled up here. Let's go over their numbers first. They beat on profits and revenue. The stock's up about 10%. Revenue for the fourth quarter, up 24% year over year. Highest fourth quarter revenue ever. Demand is strong, as they say. Earnings, they almost double it. 48 cents versus 25. They beat on revenue as well. $319 million in net income for the quarter, up from $55 million a year earlier. Now, keep your eye on this number, because there's one point that I'm going to talk about in the next article. Okay, follow this along. They made in the quarter $319 million in net income, up from $55 million earlier. And if you go for adjusted earnings before interest, taxes, and depreciation and amortization, 506. Market was looking for 432. But check this out. This is a Bloomberg opinion article talking about a bullish case for Airbnb. It's lean and not too mean money machine, making the most of the post-pandemic environment. Now, check out some of the numbers they put. Now, this is an opinion piece, okay, and it's a bullish opinion piece for sure. On Tuesday, Airbnb reported its first-year profitability, $8.4 billion in annual revenue, 75% more than it achieved in the year immediately preceding the pandemic. Airbnb had already changed the world prior to the pandemic, folks. The pandemic accelerated things, to say the least, right? But they were a force. Absolutely remarkable that you can have a 75% increase in revenue versus where they were prior to the pandemic. Now, it helps, of course, that the average per night pricing, 36% higher than where it was in 2019. Whew. Yeah, it gets pricey, man. Annual nights and experiences booked have increased by 1/5 since 2019, while headcount is 5% lower. The company's kept their workforce lean. That's what they're talking about. Check out the revenue. There's your acceleration, okay? And check out employees. Yeah, they did not fall into the trap of just hiring, even though they saw revenue skyrocketing and almost doubling from prior to the pandemic. Now, here's the part I want to get to in terms of the profits they had. Last article we were looking at, what did it say? It said $319 million in net income for the quarter. Okay, now check this out in terms of where they're making money right now. Oh, come on. Don't fail me now. Oh, forgive me. Oh, no, excuse me. I'm on the wrong article. There we go. Okay, the part I want to get to, folks, is the cash they have, and check this out. It helps that Airbnb has amassed more than $14 billion in cash, okay? That includes almost $5 billion of customer funds paid in advance of their trips. Well, guess what? What's happening right now? Rates are high, right? You're getting overnight lending rates at what? 4%, something like that. Thanks to raising interest rates, that cash earned a whopping $103 million interest in the fourth quarter. Yeah, that's why I talked about the number. They made $319 million in the quarter, and a third of it was because they were getting paid interest on billions that they have sitting there to the tune of $103 million, making up 30% of that number. That's not going away, at least for the next year or two, in terms of the returns they're getting on it. And it's probably not going back to zero anytime soon as well. We jump over to Airbnb as we come into this break. Up double digits, 10%. Stay tuned, folks. We're coming back with our man, Teddy Kegstat. We'll be talking some Forex, some crude, some yields. Come on back.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We get the S&Ps catching a little bit of a bid from the lows we had near the opening bell. We're negative 12 points right now in the S&Ps, about 0.3% in the red at 41.32. Folks, let's jump over to our man Teddy Kegstat. You can check out Teddy's Tiger Forex report, folks, right on the front page of TFNN under newsletters. You hit the Tiger Forex report. You can subscribe, folks. It is $97 for a month. Comes with a 30-day money-back guarantee. You gain access to his webinar, Forex Strategies and Fundamentals. I got that up there as well. Forex Strategies and Fundamentals. What is behind the Tiger Forex Report newsletter? That's a 60-minute webinar Teddy did a couple months ago. You get all of it. Check it out, folks. And we talk to Teddy every Wednesday. And, man, we got some action today, this week, Teddy. Good morning.
Good morning, Tommy.
So we got a lot of economic data since we last talked, man. We got some CPI that's running a little bit hot. We got retail sales, man, big numbers, 3%. We have a little bit of maybe a reversal on some of, whether you're talking about the dollar, or you're talking about yields, crude hovering near $80. Where do you want to kick things off this morning?
Well, we can start with crude. I'm bullish. I like crude. I think it's going to make it keep on butting up against resistance, and I can see it getting up to probably the $82 to $85 area over the next couple of weeks. So I think that there's definitely a bullish case for that. And then I think the interest rate market, you know, especially the economic data that's been coming out, really supports the fact that the Fed is not going to come off their hawkishness, I think, for quite some time.
I know we always talk Forex, we talk yields, we talk, of course, commodities that shape so much of that. But what do you think? I'm just going to ask you about the S&P real quickly because you brought up, you know, those numbers. What do you think about the market sitting, you know, risk-reward wise? Did you look at that in terms of the S&P 4,100 and change? Because I think, you know, my opinion, it seems like it's at least, you know, not a symmetrical risk in terms of where inflation's going right now. For those out there following the S&Ps, do you ever look at that? Do you see any upper or lower boundary lines on the? Go for it, please.
Absolutely, I do watch the S&Ps. You know, and I think that, excuse me, one of the things that's really supporting the S&Ps right now is still earnings, you know. But I think that earnings, especially when you see these economic numbers, that they're going to start to really impact the valuations for a lot of stocks moving forward into the second and third quarter. And I really think you're going to see a lot of downgrades as well, and that's going to weigh really heavy on the S&Ps. I'm a sell rally forecaster right now for the stock market. I'm not bullish whatsoever. I don't think we have a real bullish case for the stock market, you know, especially with inflation. You know, the Fed wants to have inflation down to a 2% mark. Well, that's great. We're not going to hit that anytime soon, you know. So with that being the case, you know, unless we have some sort of miracle environment that happens very quickly, I think that's going to really weigh each quarter as we move forward over the next 2 to 3 quarters for sure into the rest of the year. So, and
Sure.
I think that's going to really impact the dollar and other markets as well, because if the S&Ps doesn't hold to go higher over the next 2 quarters, that means that besides recession, you have a very bearish case for the stock market, and once that starts to really settle in, especially if earnings dry up, well, then you're really going to start to see, I think, the S&Ps get hit really hard and probably extend the correction down to where we could have the market down 35% from its highs easily.
Yeah, I mean, it seems, we keep getting these numbers, and I know eventually the Fed's going to reach a point that they're probably going to pause because we're at such a restrictive rate. But boy, they're lofty numbers, and then it'll be an interesting conversation in terms of how far we stretch out, and do they really go to 2%? Because what if it gets pretty sticky? That CPI pretty hot, not really decelerating like many at least are pricing.
And we have other central banks. We don't know what they're going to do yet either. So I mean, we're not going to be raising rates like the rate that we did. But as long as other central banks are still going to be leaning on a hawkish basis, the Fed that also supports them some more to keep on doing quarter-point hikes. I think any talk about them cutting rates, I think, is a joke, because before they even do that, we're going to have a period of 2 to 6 months where they probably don't touch rates at all. Because you just need to have that kind of a buffer zone, because to go from raising rates to just cutting rates, well, that doesn't make any sense. That means you made a mistake somewhere.
Yeah, and especially on the heels of maybe that CPI, which has kind of led in credence to exactly that, where it's not going to be a drop off of the ledge. We're not going to 6% to 2% over 3 or 4 months, man. We'd be fortunate to be even on a path of wherever we get at that type of a pace. You referenced the dollar. We get the dollar some considerable strength off the lows that we got kind of February 2nd at 100 and change. We're pushing 104. Maybe talk about where you see the dollar, kind of upper, lower boundaries. I know you do a great job on your Tiger Forex report where you walk through the dollar. You look at kind of maybe some upside target zones, some downside. Maybe you can walk the listeners through for the dollar index this week. Sure.
Let me give you I'll give you a couple numbers here. So for the dollar index, I would say that right now, I think we're going to be pushing that 105.61 area. That's the area that we need to cross. If we can get above there, and then I think that's going to give a nice longer-term, outlook for a bullish case for the dollar. Now, there's a lot of divergence in the dollar, so I don't think you're going to see this with every currency. Like the weakness in the New Zealand dollar versus the dollar, I think will remain. Australian dollar versus the U.S. dollar is not going to be as severe, I think, for that region. I mean, the U.S. dollar yen right now is getting a very nice bounce. For a while it was really treading those lows. But this is in corrective mode. Remember that even if we have a bullish case for the dollar versus the euro and the pound, I think that's where you have a long-term bullish case. The yen, I'd be very cautious because we don't know what's going to happen with the BOJ in the next couple of months. I would think that it may not stop the bullishness, but it should impede the bullishness. So the strength there in the dollar-yen trade, I think, is going to start to wane over the next month and a half. But I'd be careful with the pound dollar and the euro versus the dollar. Those two could really start to hit support, especially even though their central banks are going to be hawkish. There's a lot of problems going on with the economy, and like the German rate of inflation is running super, super high. It hasn't run this high since right before World War II, So, I mean, this is something that's really, really going to start to settle into their economy. And I think it's going to weigh on the euro versus the dollar, So the dollar index is going to be a very tough, jittery read. I think it'll probably be somewhat bullish on the index. But because of the divergence and the lack of follow-through, these markets aren't going to all go in tandem with dollar strength and other currency pair weakness. There's other things going on in the world. The Japanese yen, Japan's economy is not in the same state as like something, say, in the EU or versus the UK, and so that's why you're going to see that divergence, where the dollar is going to be strong, but relatively some currencies, I think it's going to have a very tough time at really trying to be too much of a bull.
It's pretty cool. I was just jumping through the charts as you were talking about those different Forex pairs, and substantially different charts, and man, I know I'm aware of it. I know we've all seen it, but the move in the euro, the move in the pound, just huge off of some of those lows. Euro, 95 practically to 110 in the pound.
Like
as
for the pound, I think you could probably give a case that, let's see, probably over the next few weeks, if the economic data keeps going the way it's going, I think you could see the pound be down another $3, down to that 116 area, maybe even push 115. Unless they have any, Bank of England intervention, which I don't think that's going to even really matter.
Yeah, crazy, man. It's almost down 3 pennies even from that spike high yesterday. Yeah.
Yeah.
And we got 30 seconds. What do you think of yields, Teddy, where we are right now?
Yields, I think we're going higher. I like it. I think that the way the bond market was trading over the past couple of weeks has kind of confirmed that. Let's see. I think for yields, we could probably see the 30-year get down towards the, I would say the 10, around 125.
That's all right. I tell you what. Can you hang with us for the break real quick? Can you hang with us?
Sure. Yeah.
Let's finish it up with yields. We'll be right back, folks. Stay tuned, Teddy and I.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. That was quite a 5-minute bar. We got the S&Ps right now pushing session lows down about 27 points. You see it. I got it up on a 5-minute basis, man. Market's just dropping to the lows right now, down about 0.6%. We're talking to our man, Teddy Kegstad, writer of the Tiger Forex Report every Monday, folks. I got the Tiger Forex Report up here. You do such an outstanding job, Teddy. I didn't want to rush you. And I know you always talk about the 30-year. So first, if you could give us your take on the 30-year. I got it up here for the Tigers on a daily basis. And then if you could maybe just talk about why you take a look at the 30-year, most importantly within your newsletter, as you take a look at the currencies, the yields, and you specifically look at that 30-year within the Tiger Forex Report.
Okay, well, number one, I look at them because interest rates are a function of currency pricing. So wherever the trend is in interest rates, it doesn't necessarily mean that it's going to totally push the dollar or whatever said currency is versus that bank. But it is going to influence. Like right now, we know the Fed is hawkish. So that means as long as they remain hawkish, that should give some strength to the U.S. dollar, at least in moments. Obviously there's other things that weigh on the dollar and can impact the trend. But overall, that is a bullish force for it right now. So, and especially like with what you see what's going on with the interest rate market. I mean, today it's kind of quiet off of the numbers, but then you have to realize that over the past 2 weeks, literally, you've had a 7-handle drop in the 30-year and what is it, like a 5.5-handle drop in the 10-year. That's a lot of market action without having any real significant news. I mean, it's economic number driven, but not really news driven. So, and the fact that where we are trading right now, I think we're trading, what is it, right around 126, 25, 30 or 25, 28 area in the 30-year. I can see us getting down towards that probably with a 125.09 area, which that would be a good support area. So about another handle or so down. Okay. But if we can get below that a little bit more, then we're looking at where if we can get down to 123 in the 30-year, well, that's really supports the bearish case for the longer-term trend for the interest rates. And then I think you could see us get down towards where we were trading back in November near those lows. Now, that's not going to happen in just a couple of weeks, but I could see it happening by June, being back to our November lows.
By June. Who knows where we're going to be by June, right? Teddy, I appreciate the time as always. Folks, check out the Tiger Forex report, please. Teddy, we'll talk to you next week, man. Have a great one.
Sounds good, Tommy. Take care.
Okay. Stay tuned, folks.